Same setup, same entry, same stop loss. One trader risks 0.5%, the other risks 10%. The chart doesn't know the difference, but their brains are having two completely different experiences. One trader is calm, watching price, thinking clearly. The other trader's heart is racing. Every tick feels like a knife. They're not analyzing anymore. They're surviving. Same trade, same market, same outcome statistically, but one of them is about to make a clear decision and the other is about to panic. You've heard risk only 2% per trade 1,000 times, but almost nobody tells you why it actually works. It's not about protecting your account, it's about protecting your mind. And today, we're going to break down exactly how position size hijacks or protects your decision-making.
Here's the explanation you've heard before. If you risk 2% per trade, you can lose 10 trades in a row and still have over 80% of your account. Risk 10% per trade, and 10 losses wipes you out completely. This is true. It's basic math, and it matters. But here's what almost nobody explains. The math isn't even the main reason the 2% rule works. The real reason is psychological. Position size doesn't just determine how much money is at risk. It determines which version of you shows up to manage the trade. A trader risking 2% and a trader risking 20% are not the same person once the trade is open, even if it's the exact same setup. When the dollar amount at risk crosses a certain threshold, different for everyone but very real, your brain shifts from "this is a trade" to "this is a threat." That threshold isn't really about money, it's about what that money represents to you. If losing this trade means you can't pay rent, or it represents 3 weeks of work, or it's the trade that was supposed to fix everything, your amygdala treats it the same way it would treat physical danger. And once that happens, here's what changes. Your time horizon collapses. You stop thinking in terms of "this is one of 1,000 trades." Every tick becomes the entire game. Your information processing narrows. You stop seeing the full chart. You start staring at the live P&L number. Your decision-making shifts from probabilistic to binary. Instead of thinking, "what's the probability this continues?" you think, "I need this to go my way right now." This is why traders move their stop loss on a trade that's too big, but rarely on a trade that's properly sized. It's not a lack of discipline, it's a different brain state entirely. Here's something most trading educators won't say. For a lot of traders, especially those trading live accounts with real financial pressure, 2% is still too much. 2% on a $10,000 account is $200. If losing $200 still creates a noticeable emotional reaction, a flash of frustration, a tightening in your chest, an urge to make it back, then 2% is still pulling you into threat mode. The right risk size isn't a percentage. It's the amount where a loss produces zero emotional charge, where you can take the loss, write it in your journal, and move to the next setup with the same energy as if nothing happened. For some traders, that's 1%. For some, it's 0.5%. For some, especially those managing real pressure, live prop firm accounts, or rebuilding after a drawdown, it might be 0.25% while they rebuild emotional capacity. This isn't weakness. This is calibration. You're not lowering your risk because you're a worse trader. You're lowering it until your brain stays online. Here's how to actually find your number. Not a generic percentage, but the size where your brain stays calm. Step 1. The flat affect test. Take a trade at your current risk size. When it hits your stop loss, rate your emotional reaction from 1 to 10. Be honest. Did you feel a spike? Tension? Frustration? If it's above a 2 or 3, your size is too big for your current state, not your account, your state. Step 2, cut it in half. If the flat affect test fails, cut your position size in half, not your stop loss distance, your position size. Same setup, smaller size, same stop placement. Take the next 5 to 10 trades at this new size. Run the flat affect test again. Step 3. Build the track record first. Many traders try to scale up after a few wins. This is backwards. Scale up only after you have a track record of flat affect losses at your current size, meaning the losses didn't disturb you. Calm execution at a small size repeated consistently is the foundation. Size comes after, never before. Step 4. Reassess during drawdowns. If you hit a losing streak, don't just push through with the same size. Cut size again. Run the flat affect test again. Your emotional capacity isn't fixed. It fluctuates with sleep, stress, life events, recent performance. The trader who adjusts size to protect their mental state survives drawdowns. The trader who doesn't gets ejected from the game. The 2% rule isn't a magic number. It's a starting point for a much deeper question. What size allows me to think clearly? Position sizing is not a risk management tool. It's a mental state management tool. The risk management is just a side effect. Find the size where losses don't touch you emotionally. Trade that size until it's boring. Then, and only then, consider scaling up. Because the goal was never to risk less money. The goal was always to think more clearly. If this changed how you think about position sizing, subscribe. New video every week. We go deep on the mental side of trading that most channels never talk about. See ya in the next one.